Hello, and welcome to the Pricing for the Planet podcast, the podcast that explores the intersection of business and sustainability. Today, I'm super excited because we are going to cover the intersection of finance and sustainability. Today, we are super lucky because we have Alex Lheritier on the podcast. Alex, thanks for being here.
My pleasure, Fabien. Great to be with you today.
Thanks again. And, again, I was, sharing with you that when we first met, we had this, very interesting conversation. And it was a mind blowing conversation. And it opened my mind and my eyes about the role of finance. So maybe before we go into too much details, Alex, you know the drill. We like to start from the end. So what would be the key takeaway you would like the audience to remember from your podcasts?
Happy to kill the suspense straight away. So the first, I would say, I've got two key points that are worth remembering. The first one is ESG equals finance, which means simply that if you miss the connection, you will not be able to go far enough on your sustainability transformation journey, and we'll see why the connection is so important. The second one is that supply chains are essential to your transformation. And why so? Because they account for roughly 90% of your total ESG impact. So if you don't get your suppliers on board, you cannot have a true leadership position in the sustainability space. And where things work very well is, in fact, when you can connect the financial element to your supply chain. And this is what we'll talk about today.
Absolutely. And again, I think what is brilliant with the company that you have created, Alex, is really like you give an incentive for your supplier to share ESG data, and then everybody is happy. The company is happy, the suppliers is happy, and you will talk more about that. But that's for me, that's a aha moment. Like finance can really be this incentive to really share more data and share more information. So as an ecosystem, as partners, everybody is going to the right direction. So
Correct.
Alex, we know each other, but for the audience, can you introduce yourself and explain your journey?
Yeah, sure, with pleasure. So I enjoy saying I've been on the dark side of the force for many years, being in banking, investment banking. I've worked with different banks, but essentially across UK, Australia, Middle East, and of course France, as you can hear from my terrible accent. So the ESG journey for me was relatively recent. I saw the emergence of green bonds 10, 15 years ago, and we all looked at that with quite some interest, saying, what's that weird thing? How can you reduce the cost of funding of clients by 10 basis points, which is not that bad, 0.1%. When you have billions of lending, well, 10 bips can make a big difference at the end of the day, for financially speaking. But it was kind of on the side. And then, I moved to a consulting firm, and we helped clients to set up their, loans, their funding strategy. And we started actually helping our clients to align banks' expectations around ESG sustainability and funding through what we call the sustainability linked loans. Essentially, you get a loan from your bank, but the pricing will be linked to your ESG performance. And at that time, it was 2-3 KPIs maximum, and that was good. And by the way, it was 2-3 KPIs on your scope 1 and 2 essentially, and that was it. And it was a good way to start. Let's be clear, it was a positive thing. Now if you fast forward, that pricing benefit has gone down tremendously. Today, if you're lucky, you get 1-2 basis point premium on your funding, and still on 2-3 KPIs. If you benchmark that with, in fact, the total number of KPIs that are required by different regulations such as CSRD, let's say 1,100 KPIs, that's quite a lot. 2-3 KPIs doesn't stand a chance to stand, because more and more investors are challenging the depth of that instrument, saying, well, how can we qualify that as a true sustainable tool with only 2 or 3 KPIs? it doesn't make sense. Even some can go as far as saying, well, it looks like greenwashing because you're focusing on what looks good, but all the rest actually you're hiding it. And that's why last year we saw a fall by 30% of that sustainability linked loan, linked bonds funding. So something is happening in the market. And my last job, I was the global head of working capital funding in a SaaS company, and I started touching the reality of it and the connection with suppliers. Because I remember meeting with a client and saying, wait a minute, you've got that CSRD move coming in, and you're publicly committed to transforming your business. So uh, how can we help you actually leverage the connections we've established with your suppliers? And they had 40,000 suppliers. And it's not a small company. And say, okay, how can we collect the data for you? And in exchange, we provide them funding, supplier financing, dynamic discounting. We'll get into the details. And this way, well, actually, we can incentivize your suppliers to do the job. And the answer I got from the client surprised me, but probably some of you have heard it a lot and say, well, why would we bother, Alex? There's no one else is doing so. No one is forcing us to do so. And by the way, that's a real pain in the ass to do that type of thing. So no, let's keep it for later. And I thought, okay, you know what? I'm shocked because this is not the way I see things evolving. This is not the type of honesty I expected from anyone between and seeing that gap between the promise, the public commitment, and the reality. And I said, okay, you know what? I need to to bring my own contribution to make a difference, to turn that exercise into a genuine exercise, but also to have a true impact. I didn't want to fall part of a greenwashing scheme. I really wanted to help buyers, corporates, and their suppliers to make a difference and incentivizing them with real money. Because what I realize is that if you don't have money to incentivize you, well, you may not have many people following you. Don't get me wrong. You have people who are genuinely committed and will do what needs to be done, come what may, without money. Even sometimes it costs them money, but at best it's 5% of the population. The rest, they need incentives to prioritize their efforts, to justify their efforts, and this is where I decided to play and hopefully make a difference.
Absolutely. So yeah, so can you explain your company and what you are doing? Because I think that's where it's brilliant, is this connection between financial incentives and ESG data.
Now, with pleasure. When I started, deep diving with my clients, I identified three key pain points. You may actually add more than that, but that's the most important ones. The first one is when you are talking to your suppliers, the level of ESG knowledge or sophistication can vary a lot from one to the other. It's some kind of like a huge exercise of flexibility to say some people know ESG very well, even better than you. If, for instance, you're dealing with AWS, with Google, they've got huge reports available online, as you know, very granular on what they're doing, what they want to achieve. So they are way more advanced than many corporates. And on the other side, you will have SMEs that are willing to do well, but they really don't know what you're talking about. What is CSRD? What is a carbon footprint? Those are important questions, but they had other priorities, and I'm not, criticizing them. They are rightly so. They had other priorities. So how do you help those companies, those people, really understand what needs to be done and why? That was the pain point number one. One client told me, if to do so, I need to hire 18 more people in the procurement team just to be able to contact my suppliers and explain to them what needs to be done, etc., etc. The second bullet point or pain point is, in fact, why would suppliers make the effort? You're asking them to work more, share more, and potentially transform their operations, which has got a cost, whether you invest in new businesses or you change, raw materials to get something that is more sustainable. It has a cost. Who will pay for it? And of course, that's the hot potato. No one wants to pay for it. The buyer wants to protect his or her EBITDA. The supplier, they say, well, if you're not paying me more, why would I sacrifice my own EBITDA that is already under pressure? So how do you solve that issue, the profitability challenge? And the third one is, how do you eliminate greenwashing, how you kill bullshit, how call it the way you want, but if I'm very specific on CSRD regulation, what it says at the moment is that supply chain performance will go through what they call limited insurance, which means essentially that you don't have to audit in details the data, the performance that is shared by your suppliers. I understand why, because it's a very challenging task. Again, if you've got 40,000 suppliers, that's a lot to audit. You just think of 40,000 suppliers, 200 KPIs each, 8 million data points to check each year. That's a lot of work. Okay, so there's a reason, but it's not forever. Now, the challenge is, how do you make sure still that the data you're collecting from your suppliers, that once again can account for 90%, 90, of your total impact, is accurate? Because if you get the wrong data, you will have the wrong assessment of what needs to be done, and the medicine may not be accurate. Think of your doctor. If you know that your thermometer is broken and he still uses that thermometer to assess whether you're sick or not, you may think twice before taking the medicine. And that's the same thing. So we thought, okay, we need to put together a solution, a platform that solves those elements. And so for that, we used, in fact, two key elements. The first one, I'm sorry, I will start with the tech. Normally it's the other way around. But when I discovered Gen AI, I thought, okay, there's something here that can be a game changer. Why? Because we can integrate all the ESG regulation, all the knowledge we've accumulated today in the public domain, and have a tool that is hyper accessible, any languages, anytime, and answer questions from suppliers on a conversational mode to say, okay, what do I need to do? What is a carbon footprint? How long does it take to get one? What's the cost? Who can help me? Those simple questions that you would normally ask consultants to help you with, well, you can get the Gen AI to do so for free. And we thought, okay, we can leverage that data and reduce, in fact, the knowledge gap in ESG. That's point number one. But also what we realized with that new technology is that we can also analyze the data, compare it with the objectives that the buyer, the company has, and then come back to them, say to each supplier and say, listen, based on what you've done so far, then based on the performance of your peers and what your client wants to do, those are the KPIs that you should focus on. Those are the target, the levels that you should reach in order to improve your score by 10, 20, 30%. And this way become more I would say, more efficient in your sustainable journey. And this way, we make it way easier for people to figure out not just what they've done, but to align themselves with the strategy of their clients. We don't need to have experts at home to compute through pivot tables the data. That's point number one. And hopefully, that's something that also makes a difference. The second point, very important, is finance. And this is the connection between finance and ESG as we discussed before. To put it simply, what I realize is that corporates, most of them, are have got huge assets that they are not leveraging. It's very similar to Uber and Airbnb. If you think about it, Airbnb, you've got a studio, you've got a villa in Auvergne. I love Auvergne. Don't ask me why. And they're not selling it. They're not renting it. And say, well, wait a minute. They came and say, we can make money out of that. That doesn't cost you anything. It gives you money, and people are quite happy actually to enjoy your home. What is the asset that corporates are not leveraging? It's called their credit rating. So for those who are not into finance, it's in fact the grade, the rating granted by three big companies, essentially, Moody's, S&P, and Fitch. Say, okay, how great are you from a financial standpoint? Or put differently, what is your probability of default over the next year? And the lower the probability, the higher your rating. And many companies have established strong ratings. Now, what do you do with it? Well, most of the time, you've got funders who would love to lend you more money, but in fact, you don't need that money. So I remember when I was a senior banker, one of my clients, every year I went to credit and said, okay, this is our total appetite for that company, a big cosmetics company. And we say, okay, this year it will be $4 billion that we alone can lend. And in practice, how much did I lend to that client? 400 million. Why? Because they were cash rich. So I had 3.6 billion that I would have been happy to lend, but no use. Now, what if you can actually use that, and not just the appetite, but the funding price? So the cost that normally I would ask, my client to pay, to transfer that low cost of funding to the suppliers and transfer that lending appetite to the suppliers. And this is what I did in my previous role. This is what now we do at Koaloo.FI, is we are going to the suppliers and say, you know what, we can fund the invoices between you and your client straight away. You don't have to wait for 90, 120 days or more, and we'll do so at the cost of funding of your client. So in practice, you can reduce the cost of funding of the supplier by 300, 200 basis points, so 2-3%. And what it means is, in concrete terms, for 2-month tenor or 2-month payment terms on an invoice that is worth $1 million, in fact, each time you can save $5,000. That's what it means. And then the question is, what do you do with those $5,000? Well, you can do whatever you want, including investing in your own ESG transformation. That's one thing. The second thing is, by doing so, we provide the company with additional funding. In fact, their turnover, that is the equivalent funding. And that is important because what I've realized is that we're talking today about globally a $5 trillion funding gap for SMEs. That's a huge number. Add to that a 3.5 trillion ESG funding requirement every year. And guess who will bear the brunt of those investments? Supply chains. It's not L'Oreal, it's not Total, it's not Tesco that will pay the bulk of this. It's their supply chains, because their supply chains account for, once again, 90% of their total impact. So that's what we address. And the last element is, how can we check the data and make sure it's accurate to eliminate the bullshit risk of fake reporting? And that's the last step of our solution.
And I think that the aha moment, it's this link, with the cost of capital and how you can leverage credit score and credit ranking from big companies and how they can share that and how they can help the supply chain. I think that's really something that is brilliant. And again, I love that because that's a perfect example of what, when we are talking about monetization, we like to talk about monetization a lot now. The GAFAM, they have become the expert in monetization. Most of the other companies are still struggling to monetize a lot. I think what you are doing, Alex, is exactly monetizing. You are giving this platform, you are giving this opportunity to get all of this data, and you don't ask for money. You say, okay, the money is in the back end. It's through finance. It's through this, sharing this credit score through your supply chain. And I think that's really, really interesting.
Thank you, Fabien. Often the haha moment when I talk to clients is, when I talk about how that solution can help them grow their EBITDA, and most of the time they say, "Wait a minute, I can see on the faces, no, it's too good to be true. That's bullshit, Alex. Because no, ESG is a cost. That's it. And we have to do it." I say no, because when you use that technique, what we call at Koaloo.FI, ESG discounting, we say, listen, if you use your own cash to fund the invoice, guess what? The interest you collect in reality comes as a reduction on your cost of goods sold on your P&L. And what it means is that, in fact, you're reducing the amount of purchases. So which means you're increasing your operational profitability, the EBITDA. However, for those who are not in finance, EBITDA is one of the core indicators used to assess or establish the value of a company. So it's a multiple of the EBITDA. So this is concretely a way where immediately you improve the profitability of your company, you improve its value, its valuation, while using your existing cash. So the connection is there, and it can be immediate. It doesn't erase the other costs. But what we're saying is that the money you're saving here can be allocated efficiently to other tasks that are real costs. And in reality, we fund the business models for sustainability within companies. This is what we're trying to achieve.
And maybe Alex, just for the audience to make, because for you it's obvious, but if we are going back to what you said, okay, let's pick. You have a big, a big company. They have a good, credit rank or credit score. Can you explain a little bit more? So from this score, you have two options. You can either use like a financial entity or another bank willing to loan money to the supplier using the credit score, the credit ranking of this big company. And because the supplier is smaller, usually they have, like cost of capital that is, higher than, the big company. That's option one. So your solution is working well with this option one. Can you explain a little bit more the option two? Because I think it's getting a little bit more technical.
No, you're right, and to make it even more complicated, you can combine option one and two.
Yeah.
So, but to make it simple, on option two, reality is, let's say you've got a pile of cash, of liquidity in your company. What do you do with it? And that's a regular question for every CFO of this world, because at some point you've got investors telling you that money is unused. So give it back to me. How? Dividend, share buyback. That's a normal question. Now, in the meantime, because normally you don't do those things every month, it's once a year more or less. What do you do with the cash? And the trade-off for many CFOs is, I use it as you described. I'll get into the details, or I invest it with my bank. So we call it certificate of deposits, which means the bank takes the money and say, money is guaranteed. I will give it back to you plus interests. And today on the dollar, it's around 4% return on an annual basis, secured. And say that's a good thing. Now, keep in mind that not so long ago, zero interest rate, they make zero money, or even they lost money when we had negative rates. So things can change again. Now, what we're offering is slightly different. Say, listen, that money, you can use it to pay straight away your supplier. So you don't wait for 90, 120 days, which is what you initially agreed with your supplier. But if the supplier is happy to benefit from that solution, you can pay them immediately. As soon as you've approved the invoice internally, that can be done. And you use your cash. Now, what happens then is you're telling your supplier, listen, if I pay you early, there's an interest for that because the money has got value. So let's say you have a 2% discount. 2% discount on that invoice is pretty common for G10 currencies, which means the 10 biggest currencies around the world, euro, USD, pounds, etc. So you have that 2% that you collect straight away. You send the money. So you had, let's say, an invoice of 100. Well, you send 98 to your supplier. Invoice closed. You've paid it. Job done. But what happens is, in reality, the $2 difference between the invoice and what actually you're sending is not categorized as a financial income, but often, always to be checked with your favorite auditors, but is categorized as a commercial reduction, and as a result, as a reduction to your cost of goods sold, so your purchases. And this is the way it works. And that's why I said, if you have a 2 months invoice and you have a 2% discount, in reality, 2 times 6 to get an annual rate, it means that you've got 12% return on liquidity by using your cash and to pay faster your suppliers. So you've got that additional return on cash, and you've got a higher EBITDA, higher operational profitability for your company. And the reason why I say you can combine the two is often you may not have excess cash all the time. I mean, you may want to allocate part of your excess cash, but not all of it. And in which case you can set it up saying, okay, up to this amount of money I will use my cash. And as soon as I don't have available cash anymore, then automatically we switch to bank funding. And then in that case, the banks will do exactly the same thing, except that it's a bank lending. The risk is with the buyer, of course, but it's bank lending, so you don't make money through that channel, at least stage one. There are ways also to structure it and still share the value with the banks afterwards.
And an important point for the audience is that most of the suppliers are using today financial, vehicles at a higher price to get paid immediately because they need the money.
You're right, and if you want, I can share it with you afterwards. But last week I saw a document from the Australian Ombudsman on funding costs for SMEs, and it was interesting because they took the time to take all the different funding options for SMEs and the associated costs. And what was very interesting is you had those different tools, including factoring, receivable finance, etc., ranging from 2% annual cost to 15-20% annual cost. And often the issue that we are facing is that those SMEs are not aware of all the options that are available to them. We often talk in the fintech space of, financial literacy or financial education that is required. We often talk about retail clients like you and I, but the reality, that's also the case for companies. Because often companies were created by very smart people who had, were engineers, who had a great idea. They put that in place, but they're not finance guys. So they didn't know about that. What we're saying here is that we can make this cheaper, easier, and most importantly, no commitment. If you want to stop the financing, you stop. You can decide, you can say, okay, all my invoices will be automatically funded, or we say, no, I will choose one by one the ones I want to fund. I check the price and then I transfer it, but come what may. Because if you've got a client that has got a way better rating than yours, a credit rating, it's very easy. They're bigger, they're listed, etc. Well, probably they've got a lower cost of funding. And why so? Because banks simply they will assess the default risk, as I said at the beginning. And the bigger you are, the more diversified you are, normally the lower your risk. But if you're a SME, you're more focused geographically, product wise, your risk is higher. And because the risk is higher, the consumption of capital that central banks are forcing banks to apply is also higher. So it's not that banks are bad guys trying to make an undecent amount of money on the SMEs. It's more that the calculation, the methodology that they have negotiated with the central bank is forcing them to consume more capital, and the factor they need to ask for more money.
Awesome. Alex, super clear. Thank you so much. Maybe last point before the end of this podcast, where can the audience go to, use your product or, like talk about it? Where should they follow you?
Thank you. So listen, you can connect with me if you want on LinkedIn, at Alex Lheritier. If other option, you can visit us on our website, Koaloo.FI. And I would say the key thing is I tend to say, in the ESG space, success is open source. You cannot have a copyright approach. We need to exchange, we need to connect. So if you've got ideas, questions, don't hesitate, come to us, happy to discuss, because the reality is you don't have a miracle solution. You don't have a miracle technology. I'm not claiming that, but we together, we can figure out how we can combine or join efforts to make it work together. So happy to discuss, and most importantly, happy to, have a real impact together for sustainability.
Thank you, Alex. And for the audience, thanks again for your interest. Today, we were super excited to connect finance and sustainability. If you want to continue this journey, you know the drill. You can follow us on www.pricingfortheplanet.com. We have our bi-weekly digests every 2 weeks, talking about the connection between sustainability and business. A huge thank you and be well.